What's up, family? So over the last 8 years, I've had the opportunity to talk to a lot of different day traders and a lot of different investors. And I can say over that time frame, probably January 2021 was probably peak insanity in terms of people interested in day trading, wanting to understand about day trading. Trading is a widely used term that covers a lot of different subsets of traders. So in today's videos, we're gonna take a deeper dive and we're gonna take a look at the different types of traders and how they're bucketed. Let's get it. What's going on, everybody? Brian Rivera here, CPA, and I wanted to welcome you back to the channel. So on this channel, I talk about a variety of different topics to include this one, where we talk about personal finance, entrepreneurship, investing, taxes, all that good stuff. So my goal here is to spread the love, spread the knowledge, and then hopefully I can save you some money along the way. So if you are brand new, don't forget to hit that subscribe button. So first up is gonna be the casual trader. Online trading accounts have, exploded. Access to them is very easy. And so a casual trader is just gonna be somebody who may have a handful of trades throughout the year. So some of the issues that I've seen with casual traders is they usually have issues when it comes to tax reporting. And that is because sometimes you may be using a consumer tax software that may not understand or can digest some of the complex transactions that come with trading the markets. And then also your local tax advisor may not completely understand complexities with trading and how these things are reported. So for an example, they may not understand the difference between how a Forex trader reports their taxes versus maybe a futures trader or even somebody who's trading cryptocurrency. So all these have different complexities. And so sometimes for the casual trader, they may not be active enough to be a business trader, but they do still have some problems when it comes to reporting their taxes. So next up, we've got the active trader. So the active trader is gonna be somebody who has an online retail account, has a couple hundred trades, but they still fall short of the criteria to qualify as a trader in securities. If you look up the famous court case, Poppe versus Commissioner, in this court case, the IRS ruled that basically a trader in securities or a business trader is gonna be somebody that has at least 60 trades per month. Now, if you annualize that number, that comes out to exactly 720 trades. So if you saw my video or that content around how to qualify as a trader in securities, the number that we usually look for is 720 trades in a given year. So the active trader may have a little bit more complex issues than the casual trader. And that's just because they may be trading multiple instruments. They have a lot more volume than the casual trader. They have issues with cost basis reporting. So a good tax planning tool would be, hey, if you're one of these people in this bucket, you're gonna realize that, hey, you don't have the ability to write off your business expenses. You don't have the ability to use Section 475 mark to market if you trade stock and options. So a tax planning tool in this scenario is you wanna make sure that you're forecasting or that you're looking towards the criteria to qualify as a trader in securities, because if you do, then you're gonna get additional tax benefits. And I'm gonna touch on that one here shortly. So next up, we've got trader in securities. And you may have heard the term trader tax status, business trader. There's a lot of different variations of this term, but basically the IRS calls anybody who qualifies as a business trader as a trader in securities. I would say a small online minority of traders qualify for trader status. I do a lot of consultations. We've done a lot of trader tax returns over the years, and my team, a lot of times we'll see is guys will say, hey, I qualify as a trader in securities. And then when we look at the data, sometimes it falls short. And guess what? You're an active trader, but you may not be a trader in securities. So how you're gonna know if you qualify as a trader in securities is we've put out an acronym, it's called the Behave Test. And so I'm not gonna go through every single piece of that particular acronym, but what I'm gonna do is I'm gonna hook you up with a video that I've done in the past, and it's still applicable today. So take a look at that video, and that's gonna tell you exactly how you can qualify as a trader in securities, and that's by following the Behave Test. So usually business traders trade retail accounts. They may have multiple accounts, but they're trading their own personal capital, and they're not trading on behalf of someone else. So once it's determined that you're a trader in securities, the two main benefits that you're gonna get. The first is you have the ability to write off your business expenses that are ordinary and necessary to execute your trading business. The key is the business expense must be ordinary and necessary. So it has to be something that can be used inside a day trading specific business. The other piece is you're gonna have the ability to elect what's called Section 475 mark-to-market accounting. Now, this is really only going to be applicable to people that trade stock and options. So if you're a Forex trader, you're not going to use 475. You may want to be looking into Section 1256 treatment, which is the same way a futures trader is taxed. Now, what Section 475 mark-to-market accounting is going to do for you, it's going to allow you, one, to get rid of wash sale reporting. So as a trader in securities, you have thousands of trades, you have thousands of transactions, and you don't want to get stuck with any issues when it comes to wash sales. So you want to first get rid of your wash sales. The second thing that it's going to do is it's gonna help you in the event you have a bad year. So if you have a bad year where you have a significant drawdown, you get ordinary loss treatment. So if you take a fat loss as a trader in securities that is taxed as a mark-to-market trader, you get to offset all of your income, whether that's other business income, whatever you have in your situation, you'll get to offset that dollar for dollar. So when you think of 475, think of this as an insurance policy in the event that something doesn't go right for you in the stock market. So in summary, a trader in securities is somebody that's going to be able to write off their business expenses and also use Section 475. If you want to get even more fancy with your tax planning, is now you have the ability to maybe set up an LLC, tax it as an S Corp. And with the S Corp, that's going to allow you to, one, create earned income, and two, unlock additional tax benefits. One is going to be the ability to contribute to retirement plans. Solo 401k, best retirement plan for self-employed, allows you $61,000 per year. The other piece is you can unlock cash balance plans. You can also deduct the cost of health insurance. You need earned income to be able to write that off through officer compensation. So next up is going to be the pattern day trader. So the Federal Reserve coined the term pattern day trader, and this is in connection with their margin requirements, also known as Regulation T, for securities purchased on margin. Now, the default margin for a retail trader is actually 2-to-1, and now it allows for intraday purchases of 4-to-1 margin, providing that you have an account over the pattern day trader threshold. Now, the pattern day trader threshold is $25,000. And if your account is not above $25,000, then what this rule says is you are only allowed to make 3 purchases within a 5-day window. So even if you have an account that's above the pattern day trader rule, this does not automatically mean that you're a trader in securities. This just means that you're able to freely trade as much as you want. If you want more information about understanding the pattern day trader rules, I actually have a video on this, and I'm gonna link that above for you to check out. Next up, we've got proprietary firm traders. So proprietary firm traders are going to be traders who are going to trade firm capital. Now, a lot of times people are attracted to the prop firm model, and that's because one is maybe you don't have enough money to get over the pattern day trader rule. You can use the prop firm model to where you can make a low upfront deposit, and in return, you get far greater leverage to trade that particular account. Maybe another reason why you would want to be a proprietary firm trader is because you want access to better education, better trading tools, and maybe you want to take risk off the table. I've seen a lot of traders who have done very well over their career, and they've decided that, hey, I no longer want to risk my own money. So maybe I get with a proprietary firm, trade their capital, in return, all the risk is now taken away from me, and it's now on the prop firm. So prop firms invite traders to their firms in 2 main ways. So some proprietary firms register as non-customer broker dealers. The regulators actually prefer LLC members. So if you're an LLC member of a proprietary trading firm, what will happen is at the end of the year, you'll get a K1, and that's gonna have your allocation of profit and loss as a whole as it relates to that particular trading firm. Now, other prop firm models may interconnect education with that actual prop firm. So maybe you go through their education, take some tests, you graduate, and now you're eligible to trade firm capital. Usually these type of traders are invited to be independent contractors. So at the end of the year, instead of you receiving a K1, you'll get a 1099 NEC, which is going to be your allocation of the profits that you've generated throughout your time with the prop firm for that year. Both traders, whether you're in a K1 or a 1099 NEC, is going to be eligible for the QBI deduction. Just keep in mind there are some income thresholds as that deduction continues its phase out. Now, for the business expense side, so if you're a K1 prop trader, your expenses are going to be charged at the firm level. So when you receive your K1, your ordinary income should be net of the expenses the firm charge you, whether that's desk fees, whether that's locate fees. I mean, there's a lot of things that are baked into the prop related expenses. So that's gonna be net. Now, if you're a 1099 NEC, now you're gonna take your business expense write-offs on a Schedule C. So your ordinary income is gonna show up on your Schedule C, and then all of your prop related expenses are gonna be deducted against that income that you generated. A fundamental tax issue I see prop traders face is around customer deposits and what to do with that. So a lot of times what will happen is a firm will take that deposit and offset it against any of your losses on your K1. Now, if you're not a K1 and you're a 1099 NAC, then you can write that off as bad debt expense. So last but not least, we've got investment managers. So simply put, an investment manager is somebody who trades on behalf of someone else. So you're trading other people's money. So as you can imagine, that's an absolute pressure cooker, trading on behalf of other people. And then also the investment manager may need a variety of different licenses, and they need to register with the proper regulatory body to make sure that they're in compliance. So investment managers handle two different types of accounts. One is you got separately managed accounts, which is known as SMAs. And then two is you've got hedge funds. So with an SMA account, the customer maintains control of that particular account. And all they're doing is they're simply granting trading power to the advisor who can place trades on their behalf. So in a hedge fund, an investor is simply pooling their money with other investors to receive an equity interest in that particular structure. And at the end of the year, depending on your ownership percentage, you're gonna receive a K1, which is gonna be an allocation of your profit and loss from that particular fund. And then hedge funds also are gonna use that carried interest provision, which is gonna help you navigate the suspension of incentive management fees as itemized deductions. But I don't wanna go too deep into the investment manager tax complexities. I just wanna make sure you understand the different types of trader, and you can be someone that's an investment advisor if you are an SMA or you trade with a hedge fund type structure. All right, family, so hopefully you found value in today's video. My goal here was to basically break down the different types of classifications of traders that I've come across in my career. You know, everybody's not cut from the same cloth. You may call yourself a trader, maybe you're trading Forex. You might call yourself a trader, maybe you're casual. Maybe you're somebody at a prop firm. I mean, there's a lot of different ways to skin the cat. So if you wanna learn more about day trader taxes, things that you need to look out for from a tax perspective, I've come out with a course called Taxonomics, which is basically an entrepreneur's guide for tax-free wealth. We've got a lot of different cool modules in there, but specific in this course, we have Day Trader Taxes 101, where we flush out all things day trader tax related. So if that's something that interests you, I'm gonna drop a link below. We'll catch you at the next video.